So I'll give you a very quick intro to me and then we'll get on to the more important people of this panel. So Andy, I'm an M&A advisor and entrepreneur myself. So I was at a firm previously and I use this word very deliberately. I think I got infected by the entrepreneurial bug and decided to go and set my own firm out. So what I do is it's always with an eye on an exit eventually, but that can be 2 years' time, that can be 20 years' time. It's working with people over that long period of time, which usually then involves, do we raise money, yes or no, what does that look like? That whole conversation through towards an exit. So it's a little bit about me. Without further ado though, we're gonna jump into this panel and I'll pass down the line. In a short bit, I've got kind of, please introduce yourself, the firm, and then what I'm actually particularly interested in for everyone here, just get some context, is what kind of deals do you do? So what does that look like? Check size and sectors that you're looking at. David, over to you.
Hi everyone, David. So I'm a director at Foresight. We're a private equity team covering the kind of full spectrum of investing from venture growth through to private equity. We typically invest up to about 15 million, but starts much smaller, sometimes checks of sort of a few £100,000. I've been doing that for about 10 years in the team. Feels weird saying that out loud, but yeah, I have. And in terms of kind of the types of deals that I do or we do, I mean, you know, typical check could be a 2 million growth round into a business that's got 1 or 2 million of revenue looking to scale up. We also do much later stage stuff. I don't know how late stage some of the businesses in the room are, but kind of more management buyouts and things like that. But I'm sort of assuming that's less relevant for today's conversation. But equally, you know, I worked on a deal with a colleague last year, which we did a 350k check into an early stage AI business. So we really do lots of different things within the team. We have to wear lots of different hats.
Perfect, thank you. Georgia?
Hi, I'm Georgia. I'm from Piper Private Equity. We're a consumer specialist private equity firm, so we only invest in consumer. We're later stage than most of you guys, so we do growth. So normally business making £5 million up, check sizes sort of 5 to 30 million, but normally the sort of business making 10 million and we put in 10 million is our sweet spot. But you know, I'm here today because we're private equity, so our relationships with founders are really important. So we meet founders a lot earlier, a lot longer than before we meet them, before we actually invest. So what we know and what we care about is early stage founders and how they grow up to where we are.
Cool. Hi guys, Ashley Abrahams. I'm the head origination at Guinness Ventures, nothing to do with the brewery. My role there is find the deal, do the deal. I've done about 70 in the 8 years or so I've been at Guinness. We're EIS and VCT investors. Each year we'll invest 20 to 40 million into sort of 10, 20 companies across any sector, typically looking for at least $1 million of revenue on that side. We'll follow on into all of the good performing businesses. Key things we're looking for are sort of really strong teams, more than any particular sector fit. Typical check sizes for us, 1 to 3 million on the initial side. And because I want to do it, a fun fact about me, somehow outside of work, I find time to do target shooting for England and Great Britain. Yeah, I'm memorable.
Perfect. Thank you very much, everyone. So we'll start out with a little bit of a loosener. So is there anything you're particularly looking at the moment or not looking at? So sector, structure of business, whatever it is, answer as you wish. David, over to you as you're next to me.
The one word answer is no. We are incredibly generalist at Foresight. We look at everything from, you know, early stage tech through to restaurant groups and manufacturing businesses and metal batching businesses and everything in between. So I always feel very, it's a cop out to say this when I say it, but it's genuinely true. We will kind of look at everything, and I guess the fun but also the challenge of the job is having to shift your mindset to the type of business that you're talking to and try and be a jack of all trades. I think we are quite cautious on consumer. We leave that to the experts in the main. We've had a couple of things that have gone really well in that space and a couple of things that haven't gone so well. But that's probably the sector that always gets the hardest time at investment committee. On the flip side, we're very comfortable with software and tech. That's where kind of the background, you know, the history of the firm comes from in terms of investing, and we kind of, you know, we're very comfortable investing in those types of businesses. But yeah, you know, broadly everything, and I think Ashley touched on it, but really good teams, a really clear proposition which gives you a right to win in the market, margins that are defensible because you're doing something different or better than competitors. Those are the sorts of things that we try and find in every business regardless of sector. So probably that rather than any particular sector.
And then George, you obviously within the world of consumer, anything
we love that the generalists have moved away from consumer. It's great for us. We've been doing consumer for 40 years. It's our total bread and butter. I think the only thing that we don't do in that space is pure play like tech. So we deal in the physical. We're focused on products, services, like site-based services. If there's a real thing that humans are actually involved with, that's what we care about. I think so. There is a lot of businesses building that consumer AI services. We don't touch that kind of stuff. We're traditional in the consumer space. I think we're really excited about the consumer market at the moment. It's been a hard few years since COVID. The consumer landscape has completely changed, the way people buy, what they care about, where they're spending their money, especially in the cost of living crisis. And actually what we're seeing coming out of that is some unbelievably brilliant, resilient, well-founded businesses who have survived that and now have these incredible foundations to grow from there. And before the pandemic, it was really easy to grow. You took some money at Meta, you could boom, incredible sales, but actually they didn't have any of the underneath pieces that meant them that they would actually grow further than that. And now we're seeing really well-founded businesses that have come through COVID and had a hard time. So we're really excited about what we're seeing in consumer at the moment.
And from our perspective, also like consumer, it's averages about a third of the deals we do on that side. I'd say we'll look at any EIS VCT qualifying sector. There's a couple of niche exceptions, but it's still about 80-90% of the UK economy will fit into those. The areas we tend to avoid are the sectors where there are deep specialist funds. So life sciences tend to avoid, really deep tech hardware in particular, where you just need far more firepower than typical VC in the UK is going to be able to provide. So sort of battery storage and things like that, where you need hundreds of millions, not tens on that side. But no, otherwise, every sector.
Cool, perfect. And then with a little nod or shake of the head from the audience, I just want to pick up on terminology Ashley used there. EIS VCT, is everyone clear on what we're talking about there? Mostly nods. We won't do. I'll do a very quick tax scheme from the government that ring fences certain funds to invest into. If you're not clear and you're interested in raising, definitely something to go away from this and have a look into.
It's about 4,000 companies a year and about 2 billion gets invested.
Yeah, you guys probably have a view. I would say it's 70% of the early stage funding or something like that, perhaps. Yeah,
about that.
Yeah, so it's worth looking into if you're not sure. Picking up on terminology though, trying to be helpful for our audience here. Do you pay any attention to what round stage it is? We've all used different terminology, and I think a lot of founders can get lost with what's a Series A, what's growth, what's private equity, what's venture capital. I'm going to go the other way around this time, Ashley. How do you think about it? Do you even care what the terminology is?
I have some strong views on this. Personally, I loathe the sort of seed A, B, C, D terminology. I've done a sort of pre-A, A+. It starts sounding like a school report. Much prefer to just talk hard numbers so everyone knows where you're at. I've done a 6 million Series C. I've done a 20 million Series A. That's a load of US terminology that used to mean something, and now I view as bleeding over here. Everyone knows where you stand if you go looking for a company with at least $1 million of revenue. Typical check size from us, 1 to 3. Round size tends to be 5 to 10, but can be subjective on the company. So yes, there's some loose buckets around sort of pre-seed, seed, Series A, B, etc. on that. But those are just a starting point. Make sure you back it up with numbers and data points, people, because I suspect you guys as well have had conversations with other investors thinking you're talking about the same thing, get 5 minutes in and realize completely different ballpark.
Yeah. Georgia, do you want to?
Yeah, no, just totally agree. I mean, we meet businesses that have been running for like 10, 15 years who are technically like Series A. So it doesn't mean, they can come to us and say that, and that doesn't mean a thing. It's about the business and what they're actually doing.
Yeah, I will also strongly agree and say, I don't know what the difference is between seed and Series A. But if you're raising money, you've got £1 million of revenue, or you've got £0 of revenue, that contextualises it enough for me.
Yeah, I agree with everyone. I was actually saying something earlier. I was just saying, I think one of the challenges you'll find as founders here is when you talk to people who've been through the process, everyone wants to say, I've done the best thing ever, and like sometimes it sounds better. I've done a £20 million seed because it sounds really impressive. Nothing matters, in my world, nothing matters until you actually sell the business. I'm sure a lot of the guys will shake hands. You're talking about paper. We can all make numbers up and look at deals in different ways. So I think bear that in mind when you're having a look. I want to just jump now to, in terms of the actual pitch to you guys. So the decks that you receive. I can see Ashley smirking. I know he's got some views on this as well. But so Georgia, we'll start with you. How important is that presentation? Is it just a door opener, or actually do you make a judgment call, would you say?
I just always think it's about the content. Well, for us, it's consumer brand, so we want that deck to look and feel how your brand does, but really your website would do that as well. So that's less important. What we really care about is what's in the deck, numbers-wise, and what's not in the deck. If you're hiding data from us, we'll immediately have questions about why those numbers aren't in there, why aren't your repeat rates in there, why isn't your EBITDA, and there is reasons. And so I think it's all about the content. But if you can tell us why it's not there because you're not happy with it and it's something you're working on, that's fine as well. So I think treat the deck like an intro, but the conversation where we actually dig into the deck with you is the bit we care about, really.
David?
Yeah, we could probably do 45 minutes on this question, I suspect. But I think it is important. It's not the be-all and end-all, but I think it's an important. You need to be able to get across the essence of what your business is doing quite quickly and understand why people should be excited about it, but also without omitting stuff that, because I think we all read these things thinking, what aren't they telling me? What's not in here? I think one of the things that's the most frustrating and always a worrying sign for an investor is you get halfway through the deck and you think, I don't know what this business does. I don't know how it makes its money. Or as one of my colleagues puts it, who pays who for what? What are we actually talking about here? So I think that is a really important thing to focus on in the kind of first couple of slides. And sometimes it's really straightforward, right? But sometimes, particularly in the tech world, not. What are you actually selling? And is there a one-line way to describe that? Because if there isn't, and it becomes quite a difficult, we've got to go and explain it to someone else. We're then 2 steps removed from the business. How's that going to translate? So I think that's super important.
Ashley?
Yeah, I've got views. I've seen about 7,000 pitch decks in my career for context and run lots of workshops on these. I think some of you in the room have benefited from my brutal feedback on that before. I hear laughter. Your pitch deck is there to get you a meeting. And again, just to give you some more context, so we'll see 1,500, 2,000 pitch decks a year, typically across the team. We'll maybe take 600 meetings. And that time is a really precious commodity that you can't get back. So your pitch deck has to be good enough to get you a meeting, but that's what it's for. It can make you, or an investor, say no to you, but it's not by itself going to make an investor say yes and just write you a check. One of the key things I'm looking for beyond what's already been said is attention to detail. So it's little things like, does the maths actually add up across slides? Are there numbers in there? Spelling, punctuation, formatting, things like that. On the basis of you're not going to put care, effort, and attention into your pitch deck, how on earth am I going to trust that you're going to be able to present to customers or others on that? We're not backing you to be great at PowerPoint. We're backing you to be able to grow and scale a team. And if you're sort of dyslexic, it's not your skill set, if you can't find someone to help you, that is a big red flag to an investor. The other thing nowadays I would say is make sure you've run your pitch deck through an AI engine, like ChatGPT, Claude, whatever, and get it to summarize for you. I don't know about you guys, but every pitch deck I get now is going through an engine and being analyzed. If you disagree with what is coming out as that exec summary, you probably need to go and rework your pitch deck. But you can never cover everything. And I can't remember the last time I read a pitch deck end to end that was more than 20 slides. 100 is too many. There can be There can be follow-ups. You're lucky.
Perfect. And I think keeping on this theme for a moment, what would you say is the biggest thing that's missing? You know, everyone talks about, oh, I need to do this presentation, but when you look at a deck, you just go, I wish they'd had a slide on this that's there, or why have they not put that in? Is there something that sticks in to do it? We'll come back down the other way. So, Ashley, is there something that's missing most?
Oh, one of the ones that I've yet to see ever in a pitch deck, but I would love to see, would be Porter's 5 Forces on that. So I'd Google it. It's a wonderful business school thing. But actually, when it's done really well, and sometimes during DD I'll get management teams to pull it together, really showcases how well you understand both your market and your competitive environment. The sort of power of substitutes, because every company has a competitor. You're looking for experts who really know their space more than that. Side and sort of where is the power dynamic? Sort of you will be buying something from someone and you will be selling something to someone. Where is the power relationship? So AI-powered businesses, for example, token costs is going to become more and more prominent as a question within that. So think about how you position your company within the wider ecosystem. There's no such thing as perfection in that, but the better you do that, the more you help other investors explain to their colleagues, show that you really know your stuff.
Yeah, I would just back that up in terms of we see a lot of decks that have got, you know, this sector is like 10 billion, and you're like, but that's not what you're actually playing in. I want you to know your part of that sector, your customers, who they are. Like, you've done the research and you know how many people, or at least estimated, you understand. You know, you've really spoken to your customer. Customer insight is hugely missing from the decks that we see. And actually, it's the number one thing we ask for first is, let's do a customer survey. What do they actually think? Who are they? Where are they? Because that's when you really understand your market. That's when you can really start to go, okay, this is a personality type. We see them here, here, and here. We can see that in these countries. Then there's your international opportunity. But if you just go, right, it's X billion in the UK and it's this many more billion in the US, that's not insight. That doesn't mean anything. So I think, yeah, the big thing we miss is real proper customer insight.
Yeah, and I fully agree with both of those. And mine would be risks and mitigants. And I think it can feel like a scary thing to put risks in, you know, in a sales document, but actually a really sort of considered, you know, small number of risks and your clear mitigants, and that show that you've clearly thought about it. For me, that demonstrates really good self-awareness as an entrepreneur. And, you know, we've all probably sat in those meetings where, actually, a guy sat in front of my IC and told them that he couldn't see what could go wrong with the business. Yeah, and we did the deal, and some things went pretty badly wrong, actually. But yeah, you know, we've all sat in those meetings where people think this is all just going to be plain sailing, and we all know it isn't. So a sort of, yeah, a really clear understanding of that, I think, demonstrates good self-awareness. And you didn't ask this, but the thing that I see in lots of pitch decks that I, you know, almost puts my back up is the little competitor analysis with all the ticks and crosses.
Oh, yeah.
See, in every pitch deck, it's completely meaningless. Yeah. So that's.
Yeah, you just invite the question of what would your competitors' one look like with you in it.
Yeah,
and if you've got that ready, kudos. But
also,
if not,
in consumer, we've probably seen your competitors' one, so we know what they're saying that you're doing. You're saying that they're not doing.
Yeah, I think for me, maybe I see businesses a stage earlier than these guys in terms of where they are in their planning and thought process. It's somebody coming out of, I'm a X revenue business, and you take that initially, go, oh great, and then actually you start to dig under it, and it's one of two extremes. It's either that was your number from like your last set of filed accounts, and actually now if you do your run rate, you were a 1 million revenue business, but now actually running at 2.5, and that's where you're currently at. Or the flip side is, oh yeah, we're forecasting next year to do, and this is probably more common, we're forecasting next year to do 6 million of revenue. You did 1.5 last year, you may be somewhere a little bit in between, but that's just that you're not there yet. So it's just trying to get what actually business are you selling right now and being very clear on that as well. I think I see that quite as a common point with people. I think then if we go from the deck, landed, it has got into one of Ashley's 600 meetings that's going on a year. That first presentation, How do you guys like to see that go? Do you want something polished? Do you like a conversation? How should founders be approaching that meeting? And I know this is a very personal thing, so everyone's probably is going to have different views here, but just at least for yourselves, how we do that. I'm going to go back down this way, David.
Yeah, I mean, I the first meeting, I think, you know, it's a discovery for the investor. It's you know, they'll have obviously read the pitch deck. That probably needs the extra layer on top to get you to really understand the business. So we've read the pitch deck. We're interested, as Ashley said, interested in meeting, want to learn more. I personally probably still need that played back to me with the founder's overlay and the story, rather than I'm probably not going to turn up to a first meeting with, you know, my 20 really detailed questions that I want to know. I suspect that comes in the second meeting once you've kind of, you know, you've heard the pitch more formally. So I think it is it doesn't need to be a formal pitch. It can be two-way, it can be conversational, but I would always expect that meeting to be more the founders doing the talking than the investor asking questions.
Yeah, it's all about the founder story for us there, that first meeting, 100%. We're private equity. When we invest, we're going to get involved. It's, you know, we know that we're going to have to work with you. So that first meeting is hearing about your business and why you love it and what you care about it, and replaying that deck back to us to explain why those bits that you pulled out that you thought were important enough to be in your pitch deck are actually in there from your perspective, because maybe we have questions but you might already answer those for us. So yeah, we normally, you know, we'll tell you a bit about ourselves and then we'll sit back and let you speak, and it doesn't have to be polished. You know, we've met so many businesses that are total rough diamonds that don't know how to do a presentation properly, but they've got an incredible business. But it's about you and whether we can work with you, whether you want to work with us, and why your business is special.
Yeah. I'd say I try and always keep the first meeting to 30 minutes, because if you can't decide within 30 minutes, if you want to spend a lot more time finding out about each other and have a second meeting, it's a waste. Used to an hour, then 45 minutes, just keep cutting it down. And typically what I'd look for within that is a sort of 5 minutes or so of introductions on both sides, just a little bit of background, maybe 10 minutes, just high level sort of what are you doing and why, what are the motivations, who's buying your product on that side, showcase just the market, the competitive position, the deal dynamics, and then I'd usually just dig into a bit about the people, the business, the market, the competitive position, and then a couple of minutes just on next steps. What I really want to get out of that is, are you ready for what could be coming your way? Because if you're just talking for sort of 30 minutes and the investor asks maybe one question, something has gone wrong on that side. But equally, I don't think the first meeting is the one to bombard. It's whether I want to follow up, get a load of more information from you, and then probably send over about 50 to 100 questions, all the little ones I've been thinking about, and then have a much longer call to talk those through once I've got properly up to speed. But that first meeting is much more of a sort of qualifier of those 600 odd meetings. Probably about 300-400 will get a follow-up, and there'll be 100 or 200 where you go, walk out and go, I have no idea what they've just spoken to me about. They're not ready, or they got very aggressive and defensive when I asked about metrics. That's a no-no. I've been sworn at once, that was special on that side. But it's very much from myself, a sort of like hygiene screen about, can you actually now explain and articulate the business clearly and concisely? Because if you can't do that on the first meeting, I don't want to deal with DD. That's going to get incredibly painful if you're going to speak for 15 minutes after who are your biggest competitors, for example.
I'm conscious of time, so we've got plenty more questions I could jump into there, but I just want to jump into a few other bits. I think, you know, it's touching on something that Georgia mentioned earlier in terms of, you know, what's not in the deck being hidden, coming on to kind of, so for everyone in the room, you do your pitch, you go through several meetings, investment committees the guys have touched on, which is where the whole firm comes together. What's the whole firm? But their investment committee comes together to decide whether they want to invest. Everything's gone well. People have agreed on valuation. We'll leave that as a topic because that could be a whole session. But agreed on valuation and now into due diligence. What are the things that can disrupt the deal completing, and what are the problems? Because this is something for you guys to think of when they give these answers. What could you be doing now ahead of trying to go and raise, because you can correct all these issues before you go into a deal, most of them. I'm going to go down this way, David. What's...
So what could disrupt in a DD process or slow things?
Yeah, deal killers in DD.
Yeah, I mean, they can come from lots of places, I guess. What I would, the best way I can think of to prepare for that is probably to go and speak to a friendly lawyer or someone like that, and ask them to send you this is what a data room could look like for due diligence. These are the sections, these are the sorts of things that should go in each section, and start pulling that together ahead of time. I mean, the number of times that we get into a DD process and, the whole way through the kind of offer letter negotiation, everything, the founders are telling us, oh, we're super well prepared, don't worry about it. Our data's amazing, our information's amazing. And then you open the data room and there's like a share register and some management accounts from last year in it. And you're like, what? This isn't enough to DD. So speak to a friendly lawyer, try and pull together the sorts of things that should go into a data room. It'll probably be quite a big exercise if they're advising you correctly, but that will save time much later in the process when you can be focusing on delivering the deal properly and making sure that you don't see, maintain the value that you've agreed and all that kind of stuff. Deal killers can come from lots of different places. I guess I'm just trying to think about how you cover the bases to make sure anything's flushed out ahead of time.
Yeah, I think that's the preparation, because it will highlight then if you've got issues. Georgia, is there anything from your perspective where you think deals have fallen over and if only they'd done this or told us this before?
Yeah, I mean, it's like I said about what's missing. It's amazing how many will start going into processes or, early will start saying, okay, let's consider it. Can we have your financials? And it takes months for people to get things ready for us because they didn't have it. They weren't ready. Maybe they haven't got a proper finance person in yet. Like, if you're going into a deal with a proper firm, your DD is going to be long, it's going to be arduous, especially for consumer at the moment. We're cautious, we check everything. It is in depth. And so you coming in thinking, this is going to be easy, get advice, get proper financial help. You don't necessarily need to have an advisor, but speaking to an advisor just to get a sense. And we would say get an advisor because otherwise you're just winging it. And, what we're doing is a big leap. Yeah, yeah, exactly. It's going to be hard. So, find out what you need and start getting your ducks in order really far in advance.
Yeah, I'd say the things that really kill a process are, other than it just gets timed out, as you guys have talked about on this. And I'd say from a venture perspective, it's about 3 weeks of actual work to get a deal done from term sheet to cash in. It's never 3 weeks. Most of that is chasing down information on that side. But the deal killers are sort of where there's a breakdown in trust, transparency and alignment on those. So our conversion rate from agreeing terms to cash in is about 95% on that. And things that tend to sort of torpedo things, shareholder disputes, dodgy revenue recognition, material fraud. On that, I've seen a lot of fun on those sides. But if in doubt, just reach out to an investor or corporate finance advisor or lawyer and go, what do you need? I won't take anything to my colleagues if I haven't got an integrated 3-statement financial model. If you can't build one, you're not necessarily expected to, just ask. I haven't connected a founder to someone we rate and trust to help build that for them in a DD-ready way. It takes sort of 2 days to a week or so for a few thousand since yesterday. On that side, sort of, it's all about what we're looking for is there's going to be incomplete teams. Do you recognize what your weaknesses are and can you find someone to help you address them? If you've never gone through a fundraising process, for the love of God, go and find someone who has to help you on it, or it will be tortuous. I've turned a lot of companies off because I can tell from the first 1 or 2 pitch they are not ready. And the easiest thing in the world for an investor to do is just come back in 6 months because you just haven't got the time or bandwidth to hold their hand through this. But make sure you at least, and you will be on the receiving end of that sometimes just because they're too busy rather than anything else, candidly. But make sure you ask them, I don't know about you guys, but I've definitely at the moment we've got 10 live deals on. There's just a finite amount of bandwidth in a sort of 7-person investment team on that. So make sure you get from the investors or the advisors what they need. I will happily share this is my starting info request list, but it starts with the foundational data typical fundraise, even early stage, is about 9 months from when you first decide to go and raise to getting cash in. Usually only 3 months of that is when you're actually out in the market. First 6 months is just pulling everything together, and you should start getting ready for an exit or next fundraise on day one. Just ask people what they need to see and just keep saving it down. If you get it right, everyone's aligned, you should be running your business off those metrics. And I don't know about you, but it's a bit of a red flag if we're starting to ask about sort of unit economics, KPIs on particularly, say, consumer businesses, and they don't know them. You should be looking at the stuff. There's a reason investors are asking. Don't do what one founder did this week and go, why the fuck do you need to do diligence on us on that side? Like, you're looking at all the wrong things. It's like, well, one, that's problematic. And two, what should we be looking at instead? On that? There's no such thing as a perfect business. If you were perfect, you'd never be talking to us. So just be very open about the sort of risks, mitigants, what's gone wrong, and just take it on head on. Yeah. That's someone you can work with.
Yeah, builds trust.
Yeah, trust is key. Once it's gone, it's gone.
Mm-hmm. I think that's a good point. We've got time for one more question, and then it's going to go out to audience questions. So in the back of your minds, think if there's anything you want to ask. As James said, be selfish and do this. So one of the things I just want to ask then is, for people thinking, do I raise or I don't, and what would it look like? We've gone through the process. The money has now dropped into the bank account. What does life post-investment look like? What can you expect, and what could be a thought that a founder should say, oh, actually, this investment business isn't for me? So, David?
Yeah, I mean, I think we try not to, because, again, we're very generalist. We do lots of deals. We've got 200 portfolio companies, I think, across the team at Foresight. So we don't have the time to get heavily involved in every business we back. We are involved, and we like to think that we add value in the right areas. But as a result of that, we try not. We're not trying to get in the way, and therefore we like to think that businesses will continue to operate as they did before. So that, the feel of the business shouldn't change much. We should have bought into the culture as much as the financials and all the other stuff. But I think the things that we will try and influence and enforce are, things like having monthly board meetings and having really good management information that goes around the team and is, and all of that kind of stuff. Often those two things mean that you need a finance director or a whether it's full-time or part-time or whatever, or a CFO. So it's those sorts of things that and the biggest one, which obviously comes off the sort of the board meeting, is decision making as a group rather than on gut feel. And I think to us that's really important. I mean, gut feel decision making can be great. It's great when you get it right, and it can allow you to react quickly. And it's probably part of the reason you became entrepreneurs, and it's probably part of the reason that you had early success, because you could spot an opportunity and go for it. It runs out of road, I would say, quite quickly as businesses scale, and you need various different perspectives and that challenge around the table. So, it's not massive change in the day to day, but I think some of those things about how decisions are made, how the important decisions are made, being consultative, being organised enough that you can prepare for a decent board meeting and have the information and send the pack out 72 hours before the meeting and all of that kind of stuff. So it doesn't feel like big changes, but I think all of that stuff creeps into does have some impact.
Okay. Georgia?
Yeah, totally. I mean, I think this is a really good indicator of, like, when you are going and looking for investors, think about what you want in that partner. Do you want because at Piper we always take 2 board seats, we're heavily involved. We're going to be adding value as much as possible. We've got, decades of experience, and that's what we bring to the table. If you don't want that, we're probably not the right partner for you. And that's a really important part about not every investor is going to be the right style for you. When you meet us, that's part of what you're thinking about. You're thinking about, is what they're offering what I want out of this? Or no, actually, I think I want a little bit more involvement. I want a little bit less. Because that's what you get afterwards. So really think about what it's going to look like afterwards for your business. And if you are one of those entrepreneurs who's like, no, I'm still doing this on my own, then you need to be like that for a little bit longer. But if you're ready to step back or expand and start bringing in more advice, then that's the kind of investor you need to look for. Because for Piper, it's all about, when we step in, it's board meetings every month, 2 board seats. We're going to expect a high level of governance. Structures are going to start coming in. We're going to expect you to start building out your teams. We always talk about 7, 17 and 70 at Piper, so that's growth stages. 7 is that entrepreneurial, 17 is that sort of when you're moving out of the startup phase, you're starting to get into proper growth, and then 70 is those big businesses. And we invest at that middle stage, so that's when you're moving out of entrepreneurial and into a proper big business. And that means that everything will change in how you run things. It's no longer the way you can do it when you're a startup. So I think, governance, structure, organizational roundness it all has to start coming in.
Yeah, I'd say make sure you do your due diligence on the investors. The typical VC investment in the UK lasts 2/3 the length of the average marriage. That's, I'd say, it's 8.5 years on that side. That just do your work, go speak to some portfolio companies, go and find ones that they've got, ideally, that are vaguely similar to yours on that side. If you ask me to provide some references, I'd be a fucking idiot to not provide sort of like the ones I thought were going to be the most glowing, which is probably the ones we've just given loads of money to and we haven't yet had a bust up because something's gone wrong, and something always goes wrong on that side. Do your work on it as well. But the key bits are sort of like everything that has just been said, there is a reason why it is being asked for and will be written into the legals. Sort of, we're not trying to take control and sort of run your business. We'll always be backing you to run and grow it, but it is a different set of skills as the business grows and evolves on that side. If an investor cannot justify why they're asking for board packs, management accounts, things like that, they're probably not doing their job very well. There are very good reasons for all of those. Why is a chair so important? The strongest correlation across our portfolio for best performers is a really good chair and a really good CFO. The ones at the bottom either have really shit CFOs or chairs, which have usually been inherited the deal, or they haven't got them on that side. So there are reasons for it. We don't expect you to know everything. We do expect you to ask. Otherwise, we're back to the wrong people. It shouldn't be hostile. Founders get too hung up on control. No investor typically wants to be running your business. Something has gone horribly wrong if that happens. What they're trying to do is preempt issues that they've probably seen. I've seen what should have been amazing exits for founders fall over the control point. And now the business is in a much worse position and things like that. So it's always ask why those things are there, but realize a lot of what comes with institutional investment is professionalization. And in terms of what you should be thinking about, milestones, it's very easy to talk, I'm raising 1 million, 5, 50, etc. But why? What's that going to get you to the next point? So if you're earlier stage, like I am raising to build out the team, get this product to market, I'm raising to get to break even, I'm raising to get to sort of 5 million of EBITDA or expand internationally, things like that. Like, what are the clear demonstrable benchmarks, yardstick milestones, that you're going to know why have you raised the money? 2, are you on track or not? No business ever hits its plan. You're either above, very rarely, or usually below, because founders are inherently optimistic. But you need to have that sort of clear early warning system and thought process and joined up thinking throughout. And that's what actually, although isn't always articulated, sits at the core of sort of management accounts, governance, data-driven decision making. The more you know, the earlier you know it, the more you can do something about it. If you're only finding out when you've got sort of a month of cash left, it's too late. But you should know, working all the way back, sort of usually you can see sort of 6-9 months ahead, which gives you time to do stuff about it. So if you're being asked for something from an investor that you don't understand, ask them why they're asking for it. And they should be able to really articulate you and educate you. And then you're already building trust and a strong relationship and you can work together.
Perfect. We're going to move on to questions. I'm just going to quickly summarise my key takeaways. You might have something different, but I'll do my best GPT impression here. So I think, first off, terminology, don't worry about it. How much you're raising, what stage are you at in terms of where's your revenue, where's your business, what maturity is it, are the key things to think about. Your pitch deck gets you through the door, it doesn't get your business money. Your meeting gets you through the door, it doesn't get your business money. The process is long, it takes a lot of time. The way I pick on what something Ashley said, but the way I like to think about it is it's like an accordion. You can't really compress it down in time, but it can take a hell of a lot longer. So have a think about it from that perspective and plan that out and get your ducks in a row. And I think now I'm going to open up into audience questions. So have we got any questions from anybody?
Yeah, I mean, great to hear from all of you, actually. It's fascinating from different stages. So one thing that's come quite clear out for most people is that metrics are very important and where you are as a business is important, and stages in terms of how you invest. So you've got criteria that ICs have to meet. And I keep hearing revenue. So I'm curious about businesses which are not pre-revenue, but not revenue generating yet, but they're more socially orientated. So imagine you're investing in Facebook, just imagine, and it's all about stickiness, repeat, DAU to MAU, without any revenue. Would you consider that, given where you, I know at P wouldn't do that, so that's fine, but you guys, how would you look at those businesses and say, if you did X, I would do Y?
So from my perspective, it's, if you are a just truly socially oriented enterprise and you're staying in that social space, you're not a venture investment for fiscal investors. Otherwise, if you're going down the sort of Facebook route, it's milestones. How well can you articulate, and still you need the data points to prove them. Sort of people will talk about flywheels a lot, but it's like marketplace businesses will be pretty common, and sort of we see lots of dual-sided ones where if they get to a scale, it becomes self-fulfilling, but it's being able to articulate that. And what we'll typically say is sort of, cool, get the story, hear that story probably at least once a week, prove why you're going to do it, and you'll come back to metrics and numbers. So if you're talking to investors that have clear decision criteria around they need some form of revenue as a proxy for product market fit and so on, and you haven't got that, find other investors. There's 323 venture investors in the UK last time I looked. They'll go at different stages, but you need to do your work as well if you're not the right fit, because all ours go, so sounds really interesting, let's talk when you hit these metrics.
Yeah, we have done pre-revenue investments before. Typically it's hard technology, so IP rich, they're developing a product, they haven't yet taken it to market. But yeah, I think speaking as Foresight specifically, we like to see those commercial proof points. So whether if you haven't, the ones that we've done that haven't been revenue generating, there are conversations going on, or there is indication that they'll get a big order the minute that the product is ready to go. What you're talking about, my sense is we are not as good at that in the UK as they are in the US. That sort of big picture, high conviction. You're going to do it for a number of you're going to hang on for a number of years while you build market share to then suddenly drop in the commercials. Feels to me like more of a West Coast style thing, but yeah.
There's not the firepower in the UK to do that.
It's interesting because the context isn't necessarily social and it will come.
Yes.
It's actually we're building it to prove people love it.
Yes.
The revenue generation is really easy. Just plumbing that in is going to cost 2 or 3 million, so I'm not going to bother doing that yet, but I've done it loads of times before, so it's that context. I think backing up the metrics is the key. Yes. I think it's possible, but then moving into this is how we're going to monetize it, and you then get excited beyond that.
And I guess you have you often have a freemium model. And when you're a software business selling on a freemium model, a big question I would always have is what's your conversion when you go, when your 3-month free trial runs out, how many people convert to a paid customer? Which is basically the same thing, when you actually say, right, you're going to have to pay for this now, what does that do to your customer base?
I'd just tag on, think of it from, put yourself in these guys' shoes, right? That they're people. It's not just an investment firm that you can't see there's people sat here. It's all about risk and reward. If Ashley or David are doing this investment and you go, it's so easy for me to just turn the revenue on and it happens, and then there comes that moment and nothing happens, they look silly. They do not want to look silly. So therefore the point is, can you not do something to do some little proof, like as David says, some freemium or some little trials or proof points just to help them out to be able to go, oh, look, I invested for these reasons, not just tomorrow will come. So it's thinking tactically sometimes of, yes, Facebook and places hadn't got loads of revenue, but there was very clear pathways there to show with it all, can you just do something within there? I think I remember very early on, you could do really stupid things. I imagine they didn't make much money from it, but you could buy gifts to send people, right? And that probably didn't generate much money, but it was just a proof point. Well, if some people are willing to pay for this, which is a bit crap, then actually later on they will. So it's just trying to give them excuses to invest rather than reasons to not to.
So I've got investors in the US who are all tech investors. How much do you want to know about the people that have invested in us already in that deck or in the meetings and so on?
I mean, we have probably two different models when we're growth investing. Our late stage growth investing, we tend to lead and we tend to say we're kind of comfortable doing the round ourselves. Then we have our sort of ventures team and we do lots of co-investing, including with guys at Guinness. And so it slightly depends what you're planning to do. If this is we need to do one more round, and you're speaking to investors who might be able to do that, they'll obviously want to know who else they're getting into bed with, but they're probably not so concerned about, well, are these guys going to be there for round 2, 3, 4, 5 afterwards? Whereas if that's what you're trying to do, if you're expecting to go and raise multiple rounds, I think your new investors are going to be very interested in the firepower of those on the cap table. And then you'll also always get the question of, well, are they going to follow? Because it's that classic thing of they know the business, so what are they doing? Why aren't they putting more money in?
Yeah, it's evidence.
It's like, can we speak to them first of all? But if we can't speak to them, don't stick them in the deck. Is an important point. And also, what type of investor are they? So I always wince when I hear sort of someone's been backed by X so-and-so, one of the most active angels in the UK. And it's like, okay, so they're going old school VC and writing hundreds of small checks. That doesn't tell me high conviction at all. That's just like, they probably thought you're worth a punt. Actually, if you've got the sort of investors that they've just been C-suite of your largest potential customer and this is their first angel investment, that has so much more weight and credibility, particularly if I could speak to them and they can articulate why you're so exciting, why are they stepping in, versus, oh yeah, I just throw my money around and see what happens on that. So just think through how it lands, because far too many companies will try and look at who we've raised from as a strength when it's actually a weakness. Or not necessarily a weakness, but it doesn't add any value at all. It's just, that is a very valid sort of power law based type of investing, but it's not the big shiny thing that you think it is.
Yeah, I very much back what everyone said there. Question at the back?
Well, thank you for being here and providing these insights. How early is too early to reach out to you guys?
Never is the glib answer.
Yeah.
The reality is it becomes a bandwidth. The question say, if you're talking to EIS and VCT investors and you know you're too early, now is a really shit time of year to try and get hold of us because I haven't cleared my inbox for a long time. And I owe a lot of people on LinkedIn apologies on that. But April, May, etc., I'll have lots of coffees with companies that look interesting for maybe a year or two's time on that. So never, but think why you're reaching out to them and ideally try and find someone to introduce you. It's not, and hasn't been for a while, thankfully, the old sort of, oh, I went to school with so-and-so, old middle-aged sort of white men network. But if you can find someone like Andy, for example, who I know and rate and respect, accountants, lawyers, the professionals, services firms you're working with, who are prepared to put a bit of their credibility on the line by introducing you, then yeah, I'll try and find time for a call. It might be in a couple of months if you're too early, but I will try and make time because I rate and trust those people.
Yeah, but I mean, we look at every single email that we get in our inbox. Well, I mean,
We'll chat later.
yeah, exactly. But you know, but also we're so specialist that actually the few that we care about, there are few. But if you don't hear back from us, but then you grow, send us an update. That might show, and then we go, oh yeah, we saw them a year ago. Okay, now we're interested. You know, it does work, especially, you know, like one of our biggest investments, Neon, we knew for a decade before we invested. Like, it does work, but you just have to have a story to keep telling us, and And I mean, I would agree, it doesn't have to be the old school like advisor style, but you'll be working with people that have worked with us if you're in the same space, whether it's like lawyers or even like tech providers. We work really closely with those of like Shopify and that kind of people. If they introduce someone to us, we're interested because there's a reason they've done that. But yeah, I think there is no too early, but I also think don't expect a response first time and keep trying.
Yeah, and just to add to that, you've got to have thick skin doing what you guys are doing, but you also only need to find one investor. So you cannot work for 322 of the investors out there if you work for one. So I would always, I've probably said this to a few people, just because I'm saying no doesn't mean your business is bad. It just means for whatever reason it's not the right fit for us or the right fit for me. So yeah, keep trying, I guess.
Just to follow up on that from a slightly different angle, is it ever bad for a founder to reach out because they're too early, and over time, let's say it's going slowly, to your point, to keep sending those updates? Is it ever a bad signal to investors to say, "Oh, I saw this," and is it ever a bad idea to be?
I think it depends on how you're going slowly.
Yeah. if you're bullshitting, and I could just pull up a previous email, it's like, you said you'd about to sign this contract and you haven't, then you'll just get called on it. If you go, we've still got a pipeline and so on, fine. Just be open and honest. Like, this is what's going well, this is what's not going well, this is what we're going to be doing over the next quarter. Investor updates are really useful for us, and just add us to the main list to help keep an eye on things. And you can always just put in a call to action, like, do you know anyone who could help us on X, Y, Z on that? Just have a clear, transparent, honest format.
Yeah, I mean, because we're much later stage, but members of my team do EEIS. We know so many people, angels. So if we'll share your opportunity if we think it's good, and also we want to help you grow to our stage. So if we can support you to get that early stage, that means that you reach our stage, even better. But yeah, be open and honest. You're right. We love to be put on investor updates.
I think we got time.
We have about 15 minutes.
Okay, we've got time for a couple more. I will just say one thing on that, which is this is very much like it applies when you sell your business as well. And I say it's the trust point that the guys have mentioned quite a lot. If you say next year we're going to do £3 million and you do £500,000, you do look silly, and it does reduce the trust. Because when you say next year I'm going to do £3 million, well, you said you were going to do it, you didn't. So actually, if you're in that meeting people early and you're talking about your next year, give a very realistic number that you think you can hit, because actually overachieving is better. It's psychology, right? And that is better than if you when I sell my businesses, I try and get them to speak to the buyers well in advance, because actually, if something just drops in your inbox, okay, it's there. But if you've been speaking to business, it said, oh, next year I'm going to do 5 million revenue and it did 6. And the next year they said, we're going to do 10 million and we did 12. When they say, well, I'm going to do 20, and maybe that is a bit of a long shot, the buyer or the investor believes it a lot more because they've got that proof that they followed through. So think about what you're doing, and good points have been said. There's a story to update on, there's something to say there. Again, I work with businesses who go to investors. I actually had somebody that I introduced to actually going, oh, should I go back to him and try him again? And I was like, nothing's changed in your business, so why would something have changed in the view? But yeah, if you've opened up 2 extra sites, or if you've won 3 new clients, then go and have a conversation. Don't just go, oh, something might have changed in their world. Have a story to tell.
It doesn't sound that impressive or impactful, but if someone comes into us and we say, oh, we saw this a year ago and they've done what they said they were going to do, that is massively powerful really as investors. Yeah. And everyone will be nodding around the table going, yeah, that's great.
Yeah. So. We see so many businesses that are like, we're going to hit 100 million. Like, we know you're not going to. It's very rare. Unicorns are unbelievably rare. But if you say, right, we've got a trajectory to 20 million, and then you do start hitting those points every year, you're getting closer to that actual realistic target, that means something.
All right. Questions? I'm just going to go. Everyone go to this other room.
Super quick one. We were here a couple of weeks ago with a guy, the founder of Switch electric bikes. This could be bad now. But you were saying a lot about including a video, short video explaining the product. Correct me if I'm wrong. Including it in the pitch deck. Is that something you would watch and is worthwhile putting together, or just stick to the slides? And
Half the time it won't make it through our email system.
Yeah, can I take something? I'm going to take something very deliberately here. I had a client who was going out to a PE deal who was a video production business. He was so keen to do it, and it was good because his whole job's to produce videos. We did not send that up. We sent the deck that was normal, that these guys can assess and can see. We just sent them a link, not attaching it for exactly that reason, but sent a link with it to all the potential investors going, oh, and he's done a video. But it was very relevant for his business because he was in video production. So it was a showcase. But I think Georgia touched on this before. His website had hundreds of videos.
We're going to look on your website, so don't waste your time making extra content. Your content that you're using to do your business should be what sells you.
So
And if you are putting a video in, it would be a slide with a link, not a file.
yes.
It can still cause a lot of issues. So if you think, I get at least 1 or 2 spear phishing attempts a day because I've had people get inserted into legal docs, email chains before and try and change the sort code numbers just for completion. Like, the amount of cyber attacks we get is ridiculous. Anything that is non-standard just risks. Actually, I will never see it because it just gets caught. So just be careful of any sort of hyperlinks. I don't like doculinks and docsends. I'd much rather just have an attachment that the virus checkers can scan. Just think it through from the investor perspective.
You don't look at Canva.
It causes problems sometimes. Any hyperlink just will set off a possible risk.
We're really simple people. Just
Yeah.
You want a
PDF is so much better. Yeah.
Also, a password protected. Please don't password protect your PDFs. Like we can't do anything with that. Sharing that around is so difficult, and you want us to be able to share your documents. If you're trying, like, there's no data in there that that we won't be telling you. You know.
Sorry, I was late. Maybe you covered this. I'm Matt, CEO of Autonomy. Are you pre-seed or seed? And what sort of ticket size? And also, do you prefer to lead or follow?
So I think, do you know, you can follow that after, but we've already covered that before. So for everyone else, we'll park that one for a second. And we can follow up with you separately on that. I think there is a video going around possibly later that you could watch the intro on. That's for you. Yeah. So I think there's a video just to save everyone else. Questions? Who hasn't gone at the back?
Hi, I'm Jodie. My question is around, is there any appetite in investing well for like profit and purpose businesses and looking at kind of social economic credentials?
Yeah, 100%. Half of our portfolio is B Corps. My role is actually a sustainability lead. The main reason it's so important for us is that it shows that you have really thought about how you're running your business and what it is doing and why it's there. And you don't have to have the most sustainable purpose, but if there is purpose, it makes your teams love working there more. It inspires loyalty in your customers. It's a really big sell for us at the moment.
Yeah, more than profit is perfectly valid. There needs to be a clear use case. The bit on the people bit that I've seen be a problem is sometimes your employees are too nice, which actually hits the impact because they're so focused on over-delivering for certain customers, whereas actually they could make a much bigger impact if they were more commercial and made a smaller impact for a lot more customers. So just always think through on those types of businesses, wherever there's a choice between being nice versus being good, always pick good, not nice. That I'd say is the structural problem, but yeah, a lot of B Corp investments and more than profits. A couple have charitable foundations, things like that. It's just, it needs to be aligned.
I think the nice is always a risk in like lifestyle businesses in general as well. Like if you're building a business is that how you want to live, a lot of your employees, they're not really there to grow, they're there to have a nice life. And so if you then start to change into growth, you need to start hiring for that mindset.
I think it's it's profit for purpose, not purpose instead of profit. Is one of the things to think.
We've had a couple of businesses we've sold in the last few years where we've really majored on, some of them were B Corps. We've majored on the social side. It's been the first page in the IM sometimes, and the feedback from the buyers has been a big part of the reason we liked this is because of that. So it's, the two things are linked. It can be purpose.
Also, the big corporates, in consumer anyway, like the big corporates, they can't re-engineer that magic, that purpose. So they're buying it in, and then they will re-engineer it. But, we've just seen Wild deodorants get bought by Unilever because they couldn't do what Wild were doing, and now Dove is doing it. But they can't create that magic that you guys have. So they wait till you grow big enough and they buy it in. So it is a real selling point.
I'm going to go right in the corner there.
Hi, George, something you mentioned earlier was about consumer insights in the decks and also kind of market size, sort of numbers and stuff. And when I created our first decks a couple of years ago, the whole TAM, SAM, SOM thing, I very quickly struggled to find high quality. We're a premium toothpaste brand, so to find what is the upper premium toothpaste market in the UK. Either I'm going to pay $2,000 to a really unreputable random consumer company in India to get the data, or I feel like I'm basically fudging some numbers that I don't have conviction in, which I don't want to put in a deck and then have to justify it to an investor.
But also, if you're part of a market being premiumized, there's not going to be. You're right. So don't worry about that bit. Focus on why your customers are going premium. So that's what I mean about customer insight. Talk to your customers. If you can prove to us that every single one of your customers is completely blown away by this product and they will never go back to buying cheap toothpaste, you're making that market. We don't need to worry about market size then, because it's a different proposition. It's about the premiumization conversion than it is. Yeah.
Try to do an index on consumer shifts.
Yeah, exactly.
So I'd say, having started my career as a management consultant doing commercial due diligence on PE and VC deals, so I've built so many market models. Think of it, what every single company can benefit from, what in consulting speak as a driver tree. So it's why are people buying your products, and just following that through. And you can make some really nice slides out of it, but it also really helps articulate your market and your customers really well. And then you can also do a bottom-up market sizing. You've got some assumptions. There's a reason you did premium toothpaste in that instance. And so you can size any market. At the end of the day, it's volume times value, what sits underneath each one of those, and just work that through. You can do that in a spreadsheet. You can do it really quickly, back of envelope, in sort of 2 minutes, or you can spend weeks on it. On that, but you could use as a proxy how much do people pay for dentists on that side, and there's 13,060 odd dental practices in the UK, because I had to do that market size a while ago, and things like that, and then how many of fee paying, private, etc., and just you can use proxies.
I think one thing I'd say is I see it a lot is businesses forget they've got one of the best data sources, which is their own customers. Do a survey, offer them a discount, or ask them who they are and what they're doing, and then you can at least kind of profile them and go, oh, across the profile in the UK, there's this many people or whatever it is. So just try and find out a bit from your own.
Yeah, we do a lot of postcode analysis. That's a really postcode analysis. Yeah. So you can map your customer and then see how many customers fit that in the UK, and that can give you a loose.
Perfect. Got time for one more. I'm afraid so. We've already had one from you, so I'm going to go to somebody new at the back, please.
Thank you. I was going to shamelessly ask one very specific one about my business, if that's okay, and one broad. So the broad one is what returns are you typically looking for? Is it a case of I'm investing X and I want to see a pathway to at least 50X, or something different? And then I guess the specific one for my business is kind of the role of IP and how you kind of value it. So we're in the home gym equipment space. Our manufacturers have the IP, but we've tried to mitigate that by having exclusive distribution rights. I guess, is that protection enough, or would you ideally like to have the actual underlying IP as well?
I mean, on the return thing, I mean, I don't know how useful it is for each of us to say what we are specifically. I think the point is you need to find out from the investors you're speaking to, what are they trying to achieve? Are they trying to achieve, 10x off their winners and everything else is going to go to zero? Are they looking for something lower than that? And then figure out kind of where is that right for you? Do you want to be it's shoot the moon or nothing, or do you want to be in a stable of companies that are going to be around a more, a lower sort of return multiple?
Yeah, so just for, we're much later stage. We expect a much lower, we're not expecting 10x. We're looking for 3 to 5 because it's a later stage, so you're not going to be growing as fast. It's not really you might have already boomed up 10x and then we come in at that later stage. So it's about what you're looking to do, and it's also about being really realistic about where you are and what capability you have. I think the IP point, so many consumer businesses don't have their IP. So you showing us that you've got that exclusivity, that you can grow with your plan with that exclusivity, that, if there was a supplier issue, you've got an ability to move that, or there's some way of dealing with that. Showing us that you know those risks and how you would mitigate them is the important bit, Yeah,
I'd say always just ask the investors. A good proxy is look at the number of portfolio companies to senior people will give you a good feel for what their risk reward profile looks like. So ours, we've got sort of 50 companies, sort of 7-8 senior people who might sit on boards. We're looking for a realistic path to 5 times return within 5 years. Top quartile will look like a 25% IRR regardless of the fund, but that's a very sort of weird niche financial metric. Just ask. If you see 3 people in 500 companies, they're unicorn hunters. On that, in terms of IP is only useful or valuable if it can actually generate cash. I see way more IP than I'd see valuable IP. Yeah. On that side, people get far too hung up on patents and things we've got a unique patent on this slight curve of this sort of device there. And it's cool, what if someone just makes a straight edge thing like that? I see quite a bit. It's how it ties into the business model, the brand on consumer. Very few consumer businesses have IP. It's much more around sort of brand, unit economics, and defensibility. If there's a reason why did you get the exclusivity on that one? And think back to sort of Porter's 5 Forces, which is my buzzword for the month, buzz phrase, is what are the substitutes? There's loads of types of gym equipment. Why that? What does that do that others can't? And there'll be other ways of doing it. Probably one version of free weights and nothing else, but why is that better? If you can really articulate that to an investor, then you're giving a lot more confidence you can sell it.
Yeah, I think just for everyone in the room, just in terms of that, or who should I do? There's lots of, the guys have touched on, lots of different types of investors you can approach. The worst thing you can do is try and be the jack of all trades, appeal to all of them. You start your business, you're choosing to raise money. You have chosen to start your business. You've chosen all of this. Pick the lane you want. I think somebody on the panel said it only takes one. That's all it takes is one investor to say yes to you. And I've been through processes where I've had 100 no's and one has said yes at a really high valuation and the deal's happened off the back of it. So think of that. Who are you targeting? If you want to shoot for the moon, go for those guys. If you want to go and present something where we won't lose your money, go for those guys. They're different investors. They're different people. Because one says no doesn't mean you've got a bad business. Because the other says no doesn't mean you've got a bad business. Go and find the right investor for you. And I'm afraid that's the end of our time of questions.